Hi guys, welcome back to the channel. Today we'll be taking a look at Plug Power and how they've been doing financially over the past couple years. So for all of you unfamiliar, Plug Power is a company that designs and manufactures hydrogen fuel cell systems. So to start off, as you can see, they do not have a PE ratio. If you see a stock that you want to invest in but they don't have a PE ratio, do not do it unless you're willing to take on the risk. So for all of you that don't know how to get the PE, you get it from dividing the stock's price by its earnings. This will give you a number that you'll want to be ideally 20 or less. So in Plug Power's case, they have earnings of a negative 1.60, as you can see right here. So if you divide Plug Power's price by those earnings, you'll be left with a negative number. The stock market doesn't recognize negative PE ratios. That is why it says NA. I would also like to say I don't invest into companies that aren't profitable. If I see a negative earnings, I just move on with my day. It's not worth my time or my money. So next, I want to talk about their dividends, which they currently don't offer. So it's perfectly fine for a company to not issue dividends to its investors. When a company does offer dividends, it's typically because they can actually afford to do it. I think it's quite obvious that Plug Power doesn't even have the choice of whether or not to give dividends. They clearly have no money. They're not even profitable. I guarantee once we get to the cash flow, it's probably garbage. The first thing I want to look at is the revenue. So it seems to be doing really well year after year, making big jumps. Then in 2020, it just decides to die. You can't even use what was going on in the world as an excuse because their main customers are Amazon and Walmart. Companies which had amazing years, there's no excuse. I would want nothing from this company for a value play. Showing no consistency. You can't just have your revenue fall off a cliff like that unless you're a stock like Carnival. All right, next I want to move into their net income now. So their net income has been decreasing. This is pretty painful to look at. They went from negative 57 million in 2016 to negative 83 million in 2019. Then they decided that wasn't bad enough, and next year they had a decrease of 612%. So as of right now, from what I'm looking at, this company is a joke. It's not okay. All right, so let's look at their shares outstanding. So I feel like I wouldn't expect anything else but for it to increase. So for all of you that are unfamiliar, the more the shares outstanding goes up, the less of the company individual investors actually own. So they are diluting their investors. You want to invest into companies that are buying back shares, not issuing them, especially as bad as Plug Power has been. Let's move into their balance sheet now. So I want to start off with their current assets. So I must say the current assets are looking pretty good. They've been steadily increasing, then they took a huge jump in 2020. But this is where I feel like it becomes even more of a speculative play because I want to ask the question, what are they going to do with those assets? And what are they going to do to start producing a profit with them? To me, this doesn't mean anything unless you're showing me consistent growth in their net income. So next, let's look at their current liabilities. So with their current liabilities, they have also been increasing over the years. They're currently at 222 million, which is an increase from their 133 million just a year before. So let's take a look at this number, 222 million. Just keep this number in mind. So they have 1.31 billion in cash, which is about 5 times more than the current liability. So this is always nice when analyzing a company when they can pay off any current liability at moment's notice because they have enough cash on hand. Lastly, I want to take a look at their free cash flow, which can arguably be the most important part of the company. It is also the biggest indicator to see how good or bad a company is managed. So as you can all see, it is terrible. The company is not healthy at all. It's up more than double what it was 5 years ago. This is such a big deal because the cash flow measures how well the company can generate cash to pay its debts and also measures its ability to fund its operating expenses. So this is not a good sign at all. In conclusion, though, Plug Power is a company you'll probably want to hold back from right now. Down the line, if they start profiting for 2 to 3 years in a row, then maybe it'll be worth another look. The stock isn't close to being worth what it is at right now. I would not be willing to pay more than $10 per share if I'm being honest. If you are looking for a speculative investment to add to the portfolio, Plug Power might be a good pick for you. As a value play, though, there is no value at the moment. It's all guesses on what the future will be. You will want to invest in the companies that have a consistent, sustainable history that will continue to grow. Finally, I would like to mention that I'm not a financial advisor. You should not base your investment completely off of what I said throughout this video. I recommend you do more research before coming to the conclusion of buying or selling. If you would like to recommend a company for me to take a look at, feel free to comment. Otherwise, I hope you all enjoyed the video and have a nice day.